Hi everyone, my name is Simon Misiewicz from Optimize Accountants, and in this video I thought I would just bring things back to basics. We're going to focus on property tax, what you need to know, what changes around, and what you can do about it. So let's get into the detail. If you're looking for any online tax calculators which are free for you to use, then use that QR code underneath me. You can find the link in the description box as well, and it will be used for UK and US taxes. All right, so let's think about the types of taxes we need to think about. There is SDLT, stamp duty land tax, when you're buying a property, VAT, which is when you're buying items for your property, refurbishment, income tax, and it could be income tax in your name or a limited company, capital gains tax, and then finally, HMRC aren't done with you when you pass away. You've paid all your taxes, 80%, no doubt, and now they still want more tax of you. Frightening. All right, let's talk about stamp duty land tax. This is not a good thing at all, because stamp duty land tax is when you buy a property, you will see that there's residential rates and non-residential rates. Why am I showing you this? Well, for many people, many of my clients are buying commercial properties that are empty or can get cheap, and then they're converting those into residential properties, which is really advantage because they're not paying such high stamp duty land tax as you would on residential property. So do think about that. I mean, £250,000 worth of property, and you're only paying 5% stamp duty, which is much cheaper than what you will be paying on residential property. All right, so we've got three bands here, haven't we? You've got the 0% at the top, 3% and 2%. What are they all about? Well, you've got the banded rate. So from £40,000, you'll be paying 0% on the banded rate up to 250,000. So stamp duty land tax banded rate doesn't start until 250,000. It starts at 5%. However, if you're buying a property in your name and it's your second property, you'll be paying 3% higher rate stamp duty land tax. If you're a foreigner buying property in the United Kingdom, you'll also pay the 2% foreign surcharge as well. Now, in most clients that I have will be buying property between 250,000 and 925,000, which is a 5% on the banded rate, 3% on the flat rate because they're buying in their own name. They've got more than one property, or they're buying it in a limited company. So they're paying that 3% anyway. And some clients of mine are internationally focused. So they are from Hong Kong, Dubai, Australia, America, Canada, many other countries to be fair, but they are buying property and have to pay the 2% foreign surcharge as well. So do plan ahead how much stamp duty land tax. There will be a tax calculator ready for you to use on our website. Right. Something called Section 24 mortgage interest relief cap came along. So it basically says you've got gross profit of 10,000, so that may be your rental income, gross rental income, less any utility bills, less any maintenance, etc., gives you £10,000. Now that could be per month, per property, per year, doesn't matter. I'm just giving you the basics here. You'll have mortgage interest costs of 5,000. Wow, that's high. Leaving you net profit of 5,000, which is also taxable, which is 50% profit. But now we need to think about, as a high rate taxpayer, Section 24 affects you. As a basic rate taxpayer, not so much. So I'm focusing very much on high rate taxpayers for now, for this example. You've got gross profit at 10,000. Now that would attract a 40% tax band because they ignore mortgage interest. They will not look at that as a cost. They will look you now at gross profit. So in this case, it's 40% of 10,000, which is £4,000 worth of tax. However, HMRC have given a 20% tax relief on that £5,000 mortgage interest cost, which is £1,000 tax relief. But it still means that this person has got a tax bill of £3,000, which is 60% of the profit that they made of that £5,000, which is an absolute shocker. I have clients that have paid 135% tax on their property profits, which means that they're paying the banks, they're paying HMRC, and have nothing left for themselves. However, we need to now think about, well, what is better then? And I would say buying property in a limited company makes a lot of sense, not just for income tax either. There are many advantages, such as capital gains tax, such as inheritance tax. There are ways to reduce those tax liabilities by using a company. I'm not going to go into the detail of that, but I just want to highlight those so you can do some research yourself. By the way, if you are looking for tax advice, use that QR code or indeed the link in the description box below. All right, so in this case, you've got the property gross profit of £10,000. You've got tax rate of $1,900. You do get a full tax relief on that mortgage interest cost. So £950 in that case. So you are paying £950 worth of tax on profits of $5,000, which is 19%, which is a very good thing indeed. Which is a lot less tax than I showed you in your personal name, by the way. We know that corporation tax is going to change, so please do take note of this. You do not get a personal out in a company. So if you are a person that has one property, two properties, and have no other form of income, then it might be better actually to have that property in your own name to utilize your personal out, especially if you're husband and wife. You could double that up and get pretty much £25,000 worth of tax-free money. On to that though, if you're using a company, anything up to £50,000 will be taxed at 19%. Then it goes up to 26.5%. Don't ask, I've got another video for that if you're not sure why it's 26.5%, not 19 or 25. But you pay that between £50,000 and £250,000. And then finally, if you have profits over £250,000, you'll be paying corporation tax of 25%. Please bear in mind, if you need to extract money out of a limited company, there are many ways to do that. I've created lots of videos, so make sure you dig out my channel and go through those videos. Now we look at capital gains tax. Now there's been some fundamental changes here. So capital gains tax, we have got this 12,300 up to April 2022, but it changed in 6th of April 2023 where the annual exemption allowance is £6,000 and that's all. So that means tax-free money. So it's dropped quite significantly. The basic rate tax band is 18%. You're probably thinking, well, I've lost my marbles again because surely the CGT rate for basic rate taxpayer is 10%. Yes, that's true if you're selling things that are not residential property. Residential property is 18%. High rate taxpayers are going to be paying 28%, not 20%. So make sure that you understand these rates and you can plan around them. Finally, as I mentioned before, inheritance tax, you've done all your taxes, now you die and they want to charge you even more. So we've got a situation here, we've got an individual and a couple, they've got net assets. So you're a single person with £1 million or a couple with £1 million worth of net assets. Please note that it's net assets because debt reduces inheritance tax. All right, so that's the first thing I would say. Tax-free would be $325,000 for an individual versus $650,000 because it doubles up for a couple. Now, some of you may be saying, well, what about the residential nil rate band? You're right, there is an additional allowance for that, but it's too much for this video. I want to just go focusing on landlords and property investors. Taxable to IHT is 675 if you're an individual, but it reduces as a couple to 350, and then tax is at 40%, which is significant. And there are many ways of getting away from this optional tax. Again, I've got plenty of videos that you can go and check out that describes this very point. Make sure you get some tax advice, use that QR code, get that link from the description box, book some calls with us to help you plan ahead and minimize that tax liability.